Welcome back to the Halftime Report. Time now for our call of the day. Credit Suisse cutting Disney's price target to $126. Jenny, you own Disney.
Right. So in that Credit Suisse price target cut, let's be real about it. They cut it to $126. That would imply a 40% upside from here. And in that report, they point out some really interesting things. They say that Disney's media business of $60 billion against its $60 billion media revenue value, they can take that and they compare that to Netflix, which is valued at $210 billion against $34 billion of revenue value. So you see that there's this massive, massive valuation gap here. From our perspective on Disney, I've been trying to come up with a good analogy, and I think it's a lot like New York City. You know, like New York City might get down and out occasionally, but you're kind of foolish if in the long term you bet against New York City. I think Disney's going through a rough patch, but if we don't think that Disney's going to create amazing content, that the theme parks will continue to be unbelievably enjoyed by people once these crazy hot temperatures, both here and overseas, cool down and people return to the theme parks. If you bet against Disney, I think it's a fool's bet. You just need to be patient, you know, wait it out and know that their earnings are going to return to, and we've been wrong on this so far, but I think they do one day. It might be a lot longer than we thought, but one day they get back to $10 a share. You know, it might be 3 or 4 years from now, but that seems to be the trajectory for me.
Really, not worried about the writer's strike, not worried about some movies not really performing, maybe the Marvel Cinematic Universe cooling off. None of those things are concerns, not to mention the legacy TV business. I mean, there's a couple things going on here.
To me, though, Frank, those are all really short term. Like, do I worry about all of those? Yes, for the next year.
Well, in all fairness, legacy TV and ESPN, that's not short term.
But it's Disney. Like, they're going to figure out a way to overcome it. They have some of the best management.
As an investor in Disney, what is it that you would think they should do with ESPN? Do they need,
I don't know.
Do they need a tech partner? No, it's a real question.
Yeah, but I really
do they need
don't
a
know.
tech partner? They need to do something.
Right.
ESPN needs to be monetized in some way. Do they need to introduce or tie it to some form of gaming? Do they need Apple? They have to do something there.
Here's what I want to see them do, which is what they've already done. I'm like, I have no idea. I'm not in that business. What I want is them to bring the best management back in this case, to fix it and figure it out. And like, don't you think that Bob Iger knows how to fix that and figure that out better than anyone else in this country?
Maybe they need activists. Yeah. I'm not sure. I'm not sure I know. I'm not sure.
Jason,
as an investor,
don't leave you out this conversation. You own Netflix. You own it too, Joe, and so do you. But Jason, I want to come to you so we don't leave you out. Your thoughts on this call on Disney?
Yeah, so I formerly owned Disney about 2 years ago, and I think, to Jenny's point, I think they have great assets, and if anyone's going to right this ship, it's Bob Iger, and I think just the fact that he's going to extend his stay a little bit longer is positive for the stock. But for me, Netflix has been the play. I mean, obviously, it's been outperforming this year. It's just hit a 52-week high. It's up 52%. They're really working through the kind of the password share. The ad-supported tier is starting to work really well, and they're starting to generate free cash flow again. So for me, I like the pure streaming play with Netflix in this moment in time. And, you know, maybe we'll revisit Disney down the road.